Hi, welcome to the web edition of our What's the Big Idea? We present these events every month for our clients, and we try to throw them up on the internet for any of our out-of-town clients to get a feel for what we've been buying lately. And they typically consist of a few thoughts on the macro global financial picture, coupled with one of the investment opportunities that we found in the last month that is priced particularly well. And this month we talk a little bit about Hewlett-Packard and got great feedback from our clients, so I'm excited to share it with you today. You'll find this deck of slides on the internet, and I'll reference some page numbers as we go. Beginning on slide 2, we'd like to begin with a little bit about our firm and who we are. We're a registered investment advisory firm in the state of Kansas. We are a small boutique portfolio management firm. We pride ourselves on better research. We really enjoy digging into the companies that we own on behalf of our clients, and we like to talk with the management teams and competitors, suppliers, any piece of information that we can get our hands on. We try to assimilate that for the betterment of our investing thesis and ultimately our returns. We practice a golden rule investing approach, which is just a simple way to say that we're invested alongside of our clients. We would have it no other way. I always pause to point it out to our guests because it's not the way that a lot of the industry works, and it's a key question in our minds. So if you're discerning doing business with an investment advisor, make sure you ask that question. We're very conservative in our approach. Our first rule is capital preservation, and I hope that comes through in this presentation today on Hewlett-Packard. Try to keep that in mind with every investment we make. I'm proud to say we practice a biblically responsible approach, and we are certified Catholic practitioners. That's a big part of who we are as people and what we do on Sundays, and that's our effort to live a life of integrity and incorporate that into what we do Monday through Friday. So that's important to us, and I always make a point to mention it. And then we seek to do business with like-minded investors. So we're concerned about a few things as they unfold on the global macro financial stage, and we present some of that data on a monthly basis, and then we try to segue into how that plays out at the individual holding level and aggregates into a portfolio that we feel like is positioned to benefit our clients in all seasons. So I'd like to put that on display for you here today. Slide number 3 is one that I show at every monthly event that we hold for our clients, and it shows total U.S. debt outstanding by sector. And as of today, we are in excess of $60 trillion across all sectors of our economy, not including entitlements. With Medicare, Medicaid, Social Security on top of that, we're well in excess of $100 trillion. Now that number is too big for me to get my mind around, so we have some other charts in here that show us the path of that. But this more so than anything else that we do as portfolio managers, this has an impact. This data point, this debt, this crushing debt that we have in the United States and around the world really influences what we do on a daily basis more than any other single data point. So we've put together, slide 4 is a new slide this month, and this is a slide with data points that I've thrown in from a newsletter that I'm in the process of writing now. We'll send it out to our newsletter distribution list later this month. I'll be writing on Taxamageddon, or the fiscal cliff that Ben Bernanke referred to when he testified to Congress earlier this year. And those are the package of spending cuts and tax increases that will go into effect on January 1st, 2013 if, and this is a big if, Congress doesn't act to move in advance of that. And right now our working theory is that Congress will make a move to extend a portion, if not all, of those spending cuts and tax increases, but it will likely be a very contentious battle leading up to that, and we expect a certain level of brinksmanship similar to what we saw in the third quarter of last year when we were trying to balance the budget and raise the budget debt ceiling and lost our AAA credit rating in the process. So these are volatile times that we're positioning ourselves for. This Taxamageddon as it stands right now, will be the largest tax increase in history. 82.9% of U.S. households face tax increases averaging $3,701. That's from the Tax Policy Center. This poses a significant threat to our recovery, those are Ben Bernanke's words, and could potentially cause a 5% contraction in the U.S. economy. So that is a very significant recession. As a part of the tax increases, we expect capital gains tax to rise from its current 15% to 23.8%, and we expect the tax on dividends to rise from 15% to 43.4%. And that last bullet point could be the most significant for our clients, especially those clients that are in the retirement phase of their life and counting on some of those dividends to for income on a monthly basis. So it would be very reasonable to expect the price of a dividend-paying stock to decline in the face of a tripling of the taxes that investors will pay on those dividends received. Investors will be less willing to pay for those stocks. So this is something that we're paying very close attention to in advance of the new year and congressional posturing around a potential delay and or just outright kicking these tax increases out, which would be the best case scenario for investors. But right now we're wait and see. We have a lot of dividend-paying stocks in our portfolio. We're not willing to sell them just yet, but we're paying very close attention to this data point. Okay, so moving on, I'm gonna flip through a lot of the slides that are in this deck. We've talked about these in months past, so if you see anything that we've presented here today that we didn't talk about, then reach out to me via email or phone, and we're happy to touch on any of this data. We have talked about it in past months, so you might also check the What's the Big Idea events that we have posted from May or June if you're interested in some of the long-term forecasts for U.S. debt and international debt as well in terms of total debt levels as they relate to GDP. You know, I will just pause and talk about slide number 7, and this is a slide that was put together by the Heritage Foundation, and I have a quote here from the Congressional Budget Office. This was in a report dated January 31st of 2012, where they said that between 2012 and 2014, revenues in their baseline scenario shoot up by more than 30%. What they call revenues, we call taxes. So that is a very significant thing and will have a big impact on our investment portfolios if it happens. So again, we're watching this very closely. Now if you look at the chart, you can see historically debt, that's tax revenues as a percentage of GDP have averaged 18%. The highest tax burden in history was in year 2000 at 20.6%. Historically, it's been a very, very difficult thing to take tax revenues as a percentage of GDP up higher than 20%, because at that threshold, GDP starts to decline because taxes become a big drag on our overall economy. So there's a self-defeating part of raising taxes up above that threshold. Not to mention that 2000 also happened to be the height of the tech bubble, so capital gains taxes, dividend taxes were extremely high during that period. We will not have the benefit of that going forward. Now as you look into the projected time horizon here on this chart, you see a red line, an orange line, and a blue line. The red line shows what happens to tax revenues as a percent of GDP under the current scenario, meaning these Bush tax cuts expire and the current expenditure cuts go into effect. And you can see here that almost immediately we shoot up to and beyond the highest tax burden that we've experienced in the last 40 years. Now that orange line is a little bit less impactful. This shows what would happen under the current proposed Obama budget for fiscal year 2013. And then the blue line shows the course we're on if the tax cuts are made permanent and the alternative minimum tax is fixed. So under any scenario, we're set to pay higher taxes. It's just a question of how quickly we raise our taxes and how impactful they are on the economy in the short term. Okay, I'm going to jump forward now to slide number 14 and talk a little bit about how we construct our portfolios here at Cush Capital. I mentioned we try to build a portfolio for all seasons. We're trying to navigate around some of these risks that we see in the global market. And to do that, we have a portfolio of what we call generals. These are your traditional, long-term, buy and hold, great businesses. So we look for businesses with a good management team, good moats, good prices. These are oftentimes your blue chip, dividend-paying securities, oftentimes brands that you'd recognize. We pair that conventional approach with special situation investing, options, hedges, and shorts. Primarily we use options, hedges, and shorts to manage the risk levels inside of our portfolio, and special situation investing is something that we wrote about in February. I have a copy here of our February newsletter. You can also find this on our website. It talks all about special situation investing and how we implement that inside of our portfolio. So on the whole, this creates a portfolio for all seasons that helps us navigate some of the volatility that's inextricably linked to these events that we see in the headlines almost daily and on the nightly news, at least weekly. Alright, my apologies, our video cut off and I let 2 weeks go by, so I'm going to try to pick up, splice these together. I hope that I hope they go together okay. I had left off right about Hewlett-Packard, so let's pick up from there. Slide number 17 shows Hewlett-Packard's revenues broken down by segment and region. If you look at the segment pie chart, you can see that 28% of Hewlett-Packard's revenues come from services and another 17% come from enterprise servers, storage, and networking. These two pieces of Hewlett-Packard's business are very strong and will form the meat of our investment thesis. So by focusing on Hewlett-Packard's strengths, we're able to get comfortable with an investment thesis that others on Wall Street have not been able to get comfortable with because of the risks embedded in their PC division and printers division. Both of those divisions are very, very profitable, but they have their challenges, and you could argue that they are in a state of long-term secular decline, which may or may not be the case. But even if they are, at today's prices, given the strength in Hewlett-Packard's other businesses, we have an incredible value opportunity. And I'm going to try to lay that case out for our investors here today. By region, you can see there that Hewlett-Packard's revenues break down 35% US, 35% Europe, Middle East, and Africa, and 20% Asia Pacific. So Europe has been slowing. That's caused a little bit of headline risk for HP over the last couple quarters, and other investors are worried about their exposure to Europe going forward. In the long run, Europe's still going to need all of the services that HP sells, and HP will be in the market to compete. So we may go through a little lull or a little recession, but HP's positioned to be a provider in those markets in the long term. So again, we were able to get ourselves comfortable with their exposure to that portion of the world. So let's move on to slide number 18, and we'll talk a little bit about management. We've been watching the HP story unfold now for about a year and a half, but we started getting particularly interested when Meg Whitman took the helm last August. We saw her come in. We were familiar with her from her time at eBay. She had a tremendous track record at eBay. She takes the helm at HP. She has a conference call with Wall Street analysts, and she says, you know, we might not be able to hit the $4.80 in earnings that we told you we were going to be able to do for 2012. We think we might be able to do $4. No surprise, the stock sells off significantly, falling from around 40 to around 23. And we thought to ourselves, I wonder what she's got up her sleeve. This would be a typical strategy for a new CEO to revise guidance downward to try to sandbag a little bit, if you will. Or best case scenario, we would like to believe that a CEO is trying to under-promise and over-deliver. So we started to get a little bit more interested, and we're watching the story unfold, and we noticed that one of my investing mentors, or not mentors, the wrong word, but somebody I hold in extremely high esteem is Seth Klarman. And we notice Seth Klarman takes a position. So we don't ever follow anybody blindly into an investment opportunity, but we do take note of the moves that other extremely smart investors make. And when Seth Klarman took a position in HP about sometime in the third quarter of last year, we took notice. Again, the story starts to get a little bit more interesting. Then when HP filed their proxy in January of this year, we got confirmation of our thesis that Ms. Whitman might be sandbagging a little bit, because her stock options priced shortly after she revises guidance down. So she revises guidance down, her stock options price, meanwhile the stock had fallen significantly. So all of a sudden we have evidence to show us that Meg Whitman got her options priced at about $23 a share. This is meaningful because it indicates to us that she has a lot of skin in the game at or around the same prices that we can buy the stock for today. Always like to buy a company's stock at or sometimes cheaper than where the executive management team is putting their own money to work, and that's the story that we have in HP today. So, let's see, I'm just making sure that I covered all the points on slide 18. I think I did, with the exception of the last two. The second to the last bullet point on slide number 18 says Cush channel checks came back very positive. This is a common piece of our investment process at Cush Capital. We will reach out to anybody that we have inside of our networks that does business with HP or works with HP or knows, maybe even competes against HP. And we were able to contact 3 people inside our network that knew a lot about the inner workings of that company, some employees of the company, and we asked them, what do you think of Meg Whitman? How is she executing on her strategy? What's the culture like? Are you optimistic about the future? Are you buying the stock? Are you putting your own money to work? And these channel checks all came back extremely positive and gave us a lot of confidence when we were building our investment thesis. Those are anecdotal, obviously, but they are meaningful, and we do incorporate them into our overall thinking with regard to an investment thesis. So, last but not least on slide 18 is very strong insider buying and stock buybacks. So let's talk about those in a little bit more detail on slides number 19 and 20. Slide 19 breaks out the insider purchases over the course of the last 2 years, and you can see here just in the last 6 months, the executive officers and directors of the company have put over $300 million of their own money to work buying back HP stock. Some of the most significant insider buying activity I have ever seen in my career as a portfolio manager. So this is very, very meaningful to us as we develop our investment thesis. Slide number 20 shows the quarterly trend of stock repurchases. You can see that the company stepped into the market in a big way with $4.6 billion worth of capital that they put to work buying back HP stock in the third quarter of last year. And we suspect that they would put another meaningful chunk of their $10 billion repurchase program to work at today's prices again. So we're on the lookout for more stock repurchases by the company, which supports the underlying value of the stock. Okay, slide number 21. Let's talk a little bit about their moat. And I set this up when we were looking at the pie graph of revenues. If we focus on their services, server, storage, and networking divisions, we feel like we have a good moat, and the earnings and cash flows from those divisions are going to support the stock price that we pay. That allows us to be a little more lenient with regard to the other pieces of their businesses that might not have such a strong moat, like laptops and printers. But let's look at that services division. When HP does business with a Fortune 500 company, for example, they can go in and position themselves as an IT outsourcer, and they can help them integrate all of their platforms and hardware solutions. And best case scenario, HP sells all of the HP hardware solutions to the firm, but they can still work with companies through their services divisions that don't use HP hardware. So there's a lot of opportunity then for growth inside of this division. Once they're in, their business becomes very, very sticky, and that forms the basis of the moat. And we like that very much. That moat is actually evidenced by Warren Buffett's purchase of IBM last year. And we all know that Buffett doesn't get into a business unless he views that business as having an extremely strong moat. And HP is IBM's second competition, I guess, in that space. They're number 2 to IBM in the services space. So we're attracted to that part of their division. High switching costs I mentioned, value-added proposition I mentioned, their operating earnings support our investment case, and then I covered all those bullet points. So let's move on to slide number 22 and talk a little bit about the mispricing, which is so crucial to anything we invest in. And you can see here that HP's cheap. HP's very cheap, trading at less than 5 times earnings, 2012 earnings. And this is all driven by fears of declining PC sales and laptop sales. And as I mentioned, both of those businesses are very profitable. But key to us are the cash flows and earnings that they bring in from their services division, in which they compete against IBM, number 2 in that space. $4 to $5 billion in earnings power comes from the services division. That amounts to 2 to 250 in when I say 2 to 250, I mean $2 to $2.50 worth of earnings per share coming from those divisions. Now, if we put an average multiple, say an IBM type multiple on just those earnings, so 14 times earnings, 14 times 2 is 28, that gets us to a fair value target for HP of 28. Significant upside from today's price of 1850-ish. Now, putting an IBM type multiple on HP is a little bit too aggressive. IBM has better margins. It doesn't have the divisions that are a little bit questionable, the laptop and printing divisions that you might be able to argue are in a state of decline. So let's put a significant haircut on that IBM multiple and just say that the earnings coming from HP's services division are worth an 11 multiple. That gives us a basis of an intrinsic value basis of $22 to $27 per share for HP, not even considering the earnings from their laptop, PC, printing divisions, which again are very profitable divisions. So we have a very strong case that we can buy HP today at less than $20 a share, and that less than $20 a share is a tremendous value opportunity. So we're bullish on HP. Slide number 23 sums up our conclusion on HP. It's a, I apologize. Let's back up 2 more slides before we get to the conclusion. 23 is risks. I'm getting a little bit ahead of myself. Any good investor will stop to assess the risks involved in anything. Consider HP's risks. We recognize that any company that trades at 5 times earnings is naturally going to have some risks associated with it. A company doesn't trade at 5 times earnings unless Wall Street and other investors are a little bit worried about the future of the company. And certainly some of those are applicable and do apply to HP's printing division, laptops division, personal computing division. But we feel like the investment case is really made around their services, networking, servers division. And we've been able to get ourselves comfortable with the notion that the printer market and personal computing market is in a state of secular decline, which is what most other investors are focusing on today, and is the reason why we can pick up HP at such great values. So we're excited on HP. Slide number 24 is my favorite chart in this presentation. It shows HP's earnings over the last 10 years overlaid on top of HP's stock price. And you can see here that if you go back to 2003, HP was earning 83 cents per share in earnings. Fast forward 9 years to 2012, we expect HP to earn $4 in earnings per share, nearly a fourfold increase, Meanwhile, you can buy the stock for less than $20 today, same price you could buy it for back in 2003. So we have significantly more value embedded inside of this company today than we had 9 years ago. And that's really what we're so attracted to here as far as HP's investment thesis goes. Lastly, our conclusion slide is number 25. HP is a turnaround story. All of their businesses are profitable, even printers, even laptops. They have the number 2 position behind IBM in consulting and services, which is key to our investment thesis. The bar is set extremely low. If HP can get margins back to their historical average, then we don't see any reason why the stock can't go to 40 or higher. So we're excited to own it, and slide number 26 is a slide entitled Call to Action. We would really appreciate it if you would engage us. If you've taken the time to watch this presentation, then reach out to us and let us know what you think about our investing thesis. Engage us a little bit if you have questions or comments. We want to hear from you. Reach out to us via email or pick up the phone and call us, and we'll tell you what we know about HP, how our investment thesis is unfolding, and we'll tell you about how that aggregates up into a broader portfolio construction process for our individual clients. So we look forward to hearing from you. Mark your dates, mark your calendars for Wednesday, August 8th at 7:30 a.m. That's our next What's the Big Idea event. Hope you can join us. Thanks.